Hello there and welcome to my channel. In this video, we are coming to continue our discussion on financial statements interpretation and analysis. In my previous video, I introduced you to financial statements analysis and interpretation, and we looked at some of the popular ratios that we find in finance and accounting. So in this video, what we are coming to do is we are going to apply that knowledge to solve a past question on financial statements interpretation. If this is your first time on my channel, kindly subscribe to the channel and like the video if you find it useful. Alright, so we are going to look at a question and we'll see how we are going to go about it. So we are also going to share some exam techniques, how to solve an exam question, how to manage your time and all that. So let's get right into it. So I have my question here, and this is the question. So we have Mowe Company, an international airline which flies to destinations all over the world. It experienced a strong initial growth, but in recent periods the company has been criticized for underinvesting in its non-current assets. So we have extracts of the financial statements of the company as at June 30th, 2017 and 2016. So the current year is 2017 and the comparative year or the previous year is 2016. So we have assets, we have the non-current assets comprising property, plants and equipment, intangible assets. Then we move on to, we also have current assets, which comprise inventories, trade and other receivables, cash and cash equivalents, and then we have the total current assets. Then we also move on to our equity. We have equity shares and retained earnings, as well as revaluation surplus. And we have current assets, which is loan notes. Two current assets, trade payables and 6% loan notes. And we also have extracts from the statement of profit or loss. So we have our revenue figures from profit from operations and also have the costs. Then we also have one item from our statement of cash flows, which is the cash generated from operations. Alright, then the following additional information is relevant. So Mowe Company had exactly the same flight schedule in 2017 as in 2016, with the overall number of flights and destinations being the same in both years. And then we also have a second information. In April 2017, Mowe Company Limited had to renegotiate its licenses with 5 major airports, which led to an increase in the prices of Mowe had to pay for the right to operate flights there. The licenses with 10 more major airports are due to expire in December 20x7. Mowe Company is currently in negotiation with these airports. So that is the information that we have, and we have the requirements, and we are to use the pre-formatted table below to calculate the required ratios for Mowe Company Limited for the years 2017 and 16. And then we have a second part which says that we are to comment on the performance and position of Mowe Company Limited for the year ended 20x7. And we are to note that your answer should highlight any issues with which should be considering in the near future. So this is our question for our purpose. So the question would specify the number of ratios and the particular ratios to calculate and to analyze. So that is one thing to note. And the second thing is the structure of the comments, the analysis of the ratios. That is the most important aspect, and that is my main focus in this video. So how to structure your comments and the analysis of the ratios. So I have a few tips here to help you analyze and interpret financial ratios. So the first one here is, first of all, when you are given a question in the exam, you are supposed to identify the user or the users and format required for the question. So who is the financial statement directed to? Who are you analyzing the financial statement for? So the user of the financial statement is key when you want to analyze your financial statement, because that will help you to tailor the solution to the needs of that user. And the second one is to read the question carefully and analyze the data thoroughly. Now, there are some tricks in analyzing financial statements. When you are analyzing, you don't just see anything, because that could result in a deviation. So you have to read your question carefully and analyze the data that has been given onto you thoroughly. The third one, calculate key ratios required by the question. So as I already said, it's not every ratio that you calculate in the exam. The exam will specify the ratios to calculate. Even if it doesn't specify, the data given to you or the financial statements, the information given to you, give you a clue as to which of the ratios to calculate. And then the fourth one is to write out your answers according to performance and position. So the financial statements, basically the ratios are based on the financial performance and position of the company in question. So you are to analyze the financial statements in that regard. So you will pick the financial performance of the business, which is the statement of profit or loss and other comprehensive income, and then the statement of financial position. So you analyze the financial statements using these two categories of the financial statements. And then the fifth one is to structure your answer using categories. So you're supposed to structure the answers using categories. So as I already said in my previous video, there are 5 categories of ratios. We have the profitability ratios, we have the short-term liquidity ratios, we have efficiency ratios, we have the long-term liquidity or the solvency ratios, and then we also have the investment ratios. So these are the categories. So when you're analyzing your financial statements, you need to, after categorizing them under performance and position, under performance, which ratios come under performance? So most of the ratios that come under performance are the profitability ratios, because that is where we get the profit information from. So you have to categorize them under each of the 5 headings, and then you have to comment on the main features first. You need to comment on the main features of the financial statement. So what do we mean by the main features? Revenue is a main feature of a financial statement. So you're supposed to comment on the revenue performance, the performance with regards to the revenue of the company. You are supposed to comment on major assets of the business. For example, property, plants, and equipment. So those things can be found on the face of the financial statements. You don't need to actually do any analysis before you can see the trend of those figures, and they are so material to you have to comment on those first. And then also you continue to use relevant ratios to support your comments and arguments. So this is when you begin to use the financial ratios, figures that you've calculated, to support your arguments and your comments on the financial statements. And then you must use any information given to you in the question. So as we begin to solve this particular question, you would realize that every information given to you is actually important. And then always summarize your conclusion. Any conclusion you draw from your analysis should be summarized under a conclusion heading. So let's calculate our ratios, and then we would see how we would interpret and analyze these ratios. All right, so let's go back to our question first and then cut from there. So the first ratio we have to calculate actually is our operating margin. So the operating margin is actually operating profit margin, and so we are to, so this is supposed to be the answer and this is supposed to be the working. And now we are not expected to be quoting the formula. So you answer the question based on the information that is required of you in the question. So in this particular scenario, or in this particular question, we have been provided with columns. So this is our 2017 column for the ratios, and then we have to show the workings here. This is the 2016, and then we have to show the workings here. So come here, write my answer, and then come here and write the way I got my answer. So there is no need for me to quote the formula. And remember, from the question, the calculation actually takes only 6 marks. Only 6 marks. And the analysis takes 14 marks. So more of your efforts should be directed at the analysis and the interpretation, because that is where meaning is actually made out of whatever you are doing. The calculation is really, and so it fetches very low marks. So your emphasis should be laid on the analysis and the analysis. All right. So the first one we have to calculate is the operating profit margin, and the operating profit margin, as we know, is equal to our profit before interest and tax, and we divide that by revenue. So what is our profit before interest and tax in our question? We are not giving profits before interest and tax directly, but we are giving profit from operations. Profit from operations is the same as profit before interest and tax, or what we call a PBIT, or others also call it EBIT, or earnings before interest and tax. So we have our profit before interest and tax set to be 12,300 for 2017 and 18,600 for 2016. And then we also have our revenue figure here, $154,000. This is actually in millions, but you just forget about the zeros for now. So we also have $159,000 for 2016. So let's go back to Excel and see how we can calculate that. So I'll come here, write my equals, and we have 12,300 divided by 154,000, and I have this figure. Now I'll come here and show my working. How do I show my working? This is Microsoft Excel. So let me see. So I have this divided by 154,000. So that is my working. Let me center align it. I can also center align this, and I'm going to format this. This is supposed to be a percentage. This is a margin. Margin is in percentages, so I'll format it as a percentage, and then I'll increase it to 1 decimal place. All right. So that is it for 2017, and then I'll do same for 2016. For 2016, it was 18,600 divided by 159,000 from our question. So I have calculated that, and I will come here and show my working. 18,600 divided by 159,000. So we come to the return on capital employed. Return on capital employed is equal to our profit before interest and tax, which in this case is the profit from operations, divided by our capital employed. So let's go back to our question. So we have our profit from operations already here, and now we have to find our capital employed. Now capital employed is equal to our equity plus interest bearing debt. Equity. This is our equity. This is our equity. Our equity is the equity shares right here. So our equity is this amount here, 192. The equity is made up of our equity shares plus reserves. So this is the total equity, and then we'll add our interest bearing debts. So I'll come to my Excel, and we have equals 12,300. That is our profits from operations, and then I'll divide it and add my equity. The equity from our question, is 192,100, and then I'll add my interest bearing debts, which are two. One is non-current, the other is current. So I have my 6% loan notes, 130,960, and then I will add my 6% loan notes, current assets, current liabilities, 19,440. So I'll have my 192,100 plus my 130,960, and then I'll also add my 19,440. We have that. So actually you can download the question in the you can find a link to download the question within the video description, so you can follow along. So kindly download the question so that it will fast track my analysis. All right, so we have this. So this is return on capital employed, and this is supposed to be a percentage. So let me increase this, 3.6%. Good. And we also have, I will now show my workings. So 12,300 divided by, I'll open my brackets, it was 192,100 plus 130,960, and then I'll add my 19,440. So that is the working right there. And then I'll come to 2016. For 2016, all right, so we have it there. And then our net assets turnover, the net asset turnover is equal to our revenue divided by capital employed, which we have here. So this is our capital employed. So all the formulas that will involve capital employed, we are going to employ this figure for capital employed in those calculations. So our net assets turnover is equal to the revenue. So our revenue equals, for 2017, is going to be 154,000, and then I'll divide that by my capital employed, which is 192,100. I'll add the 130,960, and then I'll add 19,440. Close my parentheses, and I have that. And then I can copy this and paste it here, and then I'll come back here and insert my equal to sign. And then this is not in percentage, it is times. It is in times. So I can actually come here, expand my number. I'll come to custom, and I'll come to the 0.00, open quotes, and then I'll put X, which is times, close my quotes and enter, and there we have it. So that is 0.45 times. Okay. Then we come here for my 2016 figure. This will be equal to my total revenue 150, and I'll copy and then I'll paste it here and insert my equal to sign. Alright, the same format, so I'll just copy this format, come here, and then I'm gonna paste special, and the space special is Control Alt V to open the paste special dialog, and I'm going to paste the format only. So I'll just select my format only and then I'll hit OK. There we have it. Alright, so we have it there, and we have our current ratios. Current ratio is our current assets divided by our current liabilities. The current assets divided by our current liabilities. Now, all these ratios, I've explained them in detail in my previous video. So I think with the exception of the net assets turnover. So the net asset turnover is actually measuring how much we are generating, how much revenue we are generating on the assets we have employed in our business. So this one, we are talking about net assets, and from the accounting equation, we know that the accounting equation is equal to assets equals capital or equity equals equity plus liabilities. So we have our equities plus liabilities. That is the basic accounting equation. And we know that to find our equity is going to be equal to our assets minus the liabilities. Our liabilities, so this is liabilities, and that is equal to our equity, and that is equal to our equity. And this equity right here, is also known as net assets. Okay, that is why when we have the net asset turnover ratio, we took our equity, and then we added the interest bearing debts. So what we are doing is that how much did we use to finance our business, and how much revenue are we generating on that investment that we have made in our business. That is all that the net asset turnover ratio is telling us. Okay, so how much did we convert the amount we have invested in the business into revenue? That is what we are talking about. Alright, so we move on with our calculations. When we come to the analysis, more understanding would come in. Alright, then we have our current ratio. The current ratio, as I said, is equal to the current assets divided by our current liabilities. And from our question, the current assets, so I'll come here, the current asset figure is equal to 115,980 divided by my current liabilities, which is 29,920. So I'll come here, and the current ratio, mind you, is a ratio, so it is always expressed as is to 1. So whatever figure we have is to 1. Alright, so, and then we have it. Then we have the interest cover. The interest cover is equal to the interest, the profit before interest and tax, which is our profit from operations, divided by our interest expense or the finance cost. So in our question, it is finance cost that has been given to us. So as we see here, we have finance cost instead of interest expense. You can also see finance cost. They are the same. Alright, so let's go back. So from our question, the our profit before interest and tax is actually for 2017 is 12,300. I'll divide that by my finance cost, and that is 9,200 for 2017. I'll copy that, come here, paste it. Then the last one is a debt to equity ratio, which is also called the gearing ratio or the leverage. It is also called the gearing ratio or the leverage, and it compares the amount of debt to our total equity. The amount of debt to our total equity. And there are two formulas for calculating this. The first one is the debt, our total debt divided by our total equity. Or another formula is also our total debt divided by the equity plus the total debt. So in this question, we are going to use our total debt to the total equity, because that is what the question demands. So always tailor your answer to the demands of the question. Alright, so we have our debt figure, and that is going to be the interest bearing debt. When you are talking about debt, we are talking about interest bearing debt. Interest bearing debt comprises all debts that carry an interest element. So from our question, we can see that our debts here are carrying interest elements. That is why you are calling them interest-bearing debts. So 6% interest on the loan notes, 6% interest on the loan notes. And preference shares are interest-bearing debts because they carry a fixed interest on their value, on their face value. So just take note that preference shares also carry interest bearing debt. So assuming we are having preference shares in this question, we would have added them to these two elements. Okay. So this is going to be equal to so we'll have 130,960. I'll add the current one 440. And then let me put this in brackets. And then I'll divide it by my total equity. My total equity is equal to 192,000. 192,000. Alright. Now remember that this is Excel, and so I am not multiplying these figures by 100. The ones in percentages, the operating profit margin, this value is supposed to be multiplied by 100, so you can get the percentage value. So if you are doing this manually, that is in a manual exam where you are not using the computerized system, then you have to multiply these figures on your calculator by 100. So you multiply this one too by 100. So you put everything in brackets and multiply by 100. You put everything in brackets and multiply by 100. Alright. So I'll copy my figure, come here, paste it, and then I will insert my equal to sign. So I have my figure there. This is in a percentage form, or is percentage. So we are going to look at the percentage of the debt to the total equity of the business. So I'll increase it to 1 decimal place. Good. And there we have it. And then I also come here, and for 2015 it's going to be 150,400. I'll add, so let me bring my brackets, and I'll add my second debt figure 1440, close my brackets, bring my division figure, and then our total equity, and that is 44,800. I have that, and then I can copy this, paste it here, and I'll insert my equal to sign, and there we have it. So I can actually format this as a percentage, and I'll increase it to 1 decimal place. Alright, so we have calculated our ratios. Now everything that we have done here so far is only worth it is worth just 6 marks out of the 20 marks allocated. So this is So this is an exam, a past exam question. We are using it as a guide. All right. So remember that all the calculations we've done here is worth only 6 marks. Only 6 marks. And so you have to understand that majority of the marks is allocated to the interpretation of the ratios. All right. So we have this, and then we are supposed to analyze it. Now, this is the B part, is saying that we should analyze or should comment on the performance. So let me actually go to the question. And the B part of the question says that comment on the performance of Moorware Company Limited for the year ended 30th June 2017. Note highlights any issues which Moorware Company Limited should be considering in the near future. So how do we analyze this? We analyze using the tips I have given you here. So we have the categories for the ratio. So first we have identified which users. This one, the users are general. So there has not been, or they haven't mentioned any user specifically in the question. So it is a general, it's an open-ended question. So you analyze it in general. You are not going to tailor your analysis to any user of the financial statements. So we'll categorize our ratios. So we have the performance and then the position. So the performance is talking about our profitability. And from our ratios, the operating margin here is a performance ratio. Return on capital employed is a performance ratio. And then also the net assets turnover ratio is also a performance ratio. Then the current ratio and the interest ratio are position ratios. They are why do we say they are position ratios? Because the figures we use to calculate these two ratios are derived from the statement of financial position. That is why they are called position ratios. These three, the figures we use for them are derived from, we use revenue. So revenue is found in the statement of profit or loss and other comprehensive income. And so that is why you are calling them performance ratios. The debt, and then the debt to equity ratio is also a position ratio. All right. Now that we have categorized so you will start the analysis by writing performance. Then underperformance. So underperformance, you are not going to analyze your financial ratios. So the first thing here, so we have identified the users and the format required for the solution. So this is the format for the solution. Okay, the performance and position is already is derived from the question. And how did we get that? We have our question here. From the question, the ratios are actually performance and performance. These are performance and position ratios. Okay, and that is the reason why we have performance and position right here. And the question also went further to tell us that we should highlight any issues should consider in the future, any issues the company should consider in the future. And that is the reason why we have issues to consider in the future paragraph in our analysis. And as the tips I have here goes, we are to always conclude our analysis, our interpretations, and our analysis. So that is the reason why we have these three figures here. Now let's look at performance. So from the question, I hope you have downloaded the question from the video description so you can follow along, because I cannot be going back and forth, and because that is going to make our the length of the video very long. All right, now we have to some of the major elements in the financial statements, and the first one is the revenue. And from the question, we can see that the revenue of Moorware Company Limited has declined in the year 2017, comparing it with that of 2016. So where is our revenue? This is our revenue. We have 154,000 here, 159,000 for 2016, and 159 154,000 for 2017, which means that there has been a decrease in the revenue by $5 million, and that is a lot of money. All right. And remember, when you are analyzing financial statements, I said this in my previous video, you are not just coming to say that revenue increased in the current year by this amount and then you stop there. No. The examiner is actually interested in the cause of that decline. What is the possible cause of the decline in revenue? Why is this particular ratio trending? Why is it declining? Why is it increasing? What possible steps can the company take to be able to correct that in the future? That is what the examiner is looking for, and you are to use provided information provided in the question to answer these questions. You are not supposed to write some textbook definitions of your ratios and then that is it. No, you are supposed to tailor your answer based on the question. Okay, based on the question. So your analysis should be comprehensive enough, but it shouldn't contain things you have learnt by rote in the textbook and then you write it down. No. All right. So we have seen that the revenue has decreased. Now, what is the possible cause? Now, we've been told in the question that Moe company had exactly the same number of flights in the year. The same number of flights in the year. And so the decline is not due to the number of flights, but it can be due to either lower number of passengers that Moe company recorded over the year, or it can also be due to the fact that perhaps they have reduced their price on the flights. Okay, so either the number of passengers reduced or the price charged per passenger has reduced. Okay, and that can be a possible cause of the revenue declining in 2017. So this is how you analyze your financial ratios or the financial statements. And then let's go to the operating profit margin. Now we know that we used the revenue to calculate our operating profit margin. The operating profit margin has also declined, and this can be attributed to the fact that revenue declined. Okay, revenue declined. So as the number of flights operated by Moe company has not remained the same, it will appear that a number of the costs incurred by Moe company on the operation of the airline would be relatively fixed. Okay, it will be relatively fixed and may not have changed significantly during the year. So it can be noted that there has been an increase in the cost of licenses charged by the airports during the year, which would again cause the operating margin to fall. So we have some additional information in the question. So this is our question. So how to negotiate each licensing with the 5 million, which led to an increase. See, there has been an increase in the licenses that Moe company paid during the year, and so that has had resulted in a decrease in our profit margin. Why? Because licenses are amortized, and amortization is a drain on profit. We subtract or we deduct amortization just like we deduct depreciation. Okay. So this is the possible cause of our operating margin declining from 8.7% to 3.6%. That is a significant decrease in our operating margin. Oh, sorry. So this is 11.7% and this is 8%. A decrease of 3.7% of our profit margin. Now we go to the return on capital employed. That one too has declined significantly. Now there are two major reasons for this. From our question, there are two major reasons for this. First, there has been a decline in the profit from operations, as we have seen in our question. So the profit from operations has declined. This is 18,600. This is 13,300, 12,300. So there has been a decline in our profit from operations, which we used in calculating the return on equity, return on capital employed. Sorry. So we have that. And then in addition, Moe Company has revalued its non-current assets in the year. So there has been a revaluation in the year. This means that there is a large revaluation surplus in 2017 which did not exist in the 2016 financial year. So let's come to the question and confirm that. So we have our revaluation surplus here, and that is $145 million for 2017, but nil for 2016. See that? So that is the possible cause of our return on capital employed declining over the year. And this is due to the fact that our total equity balance has increased. This is capital employed. This is our denominator. The denominator is the equity elements of the formula. And since it has increased, the ratio is likely to decrease. Looking at this, we have seen that the profit from operations has decreased. However, our equity has increased because of the revaluation surplus in our equity. So, since the denominator has increased and the numerator has decreased, this will make the result a decreased result, okay, as compared to this one. So this is a relatively higher profit from operations, and the equity element is very low compared to 192,100 to compare this 44,800 to 192,100. This is a significant increase, and that is because we have added a revaluation surplus of that 145,000 of revaluation. So you see, this is a guide as to how you analyze your financial statement. So you identify that, okay, there has been an increase or a decrease in the ratio. Now, you analyze the ratio using the information in the question together with the elements making up the calculation of the ratio. Okay, the elements making up the various calculation of the ratio. So that is how you calculate it. And I hope you can use the same procedure to analyze the current ratio, the interest cover. Is the same procedure. Look at the information we have in our question and look at the individual elements forming up the ratio calculation, and then you analyze the decrease or the increase, the cause of that. And the question also says that we should consider the issues, or we should look at the issues that the company is likely to consider going forward. Now, from our question, we'll go back to my question. From our additional information, there has been issues about licenses, and we have seen that Moe Company Limited had to pay for the right to operate their flights. The licenses with 10 more major airports are due to expire in December 2017, and Moe Company Limited is currently in negotiation with these airports. So what are some of the issues that we are supposed to consider? We can see that there are a number of things to consider regarding the future performance of the company, obviously, okay, from this information. The first of these is the 10 major licenses which are due for negotiation with the airports. If the price is raised on these, then this will lead to a reduced profit being made by Mowe company in future periods. Okay, so if the price that is being negotiated is raised, if it is increased, then there is going to be reduced profits in the future period of the company. So this is an issue of major concern to the company. Okay. It's of major concern to the company. All right. And then you also offer your conclusion. We also offer your conclusion, or write down the conclusion. So based on the performance analysis, position analysis, and then issues to consider in the future, what can we conclude about Mowe Company Limited? What conclusion can we make? So we can say that Mowe Company has not shown a weakened performance in the current year. The performance is not weakened. Even though there has been a decline, the performance has not been weakened, but it appears to be profitable. But rather, it appears to be profitable at its core, at the core of its operations. It is still profitable because they have made profits. They haven't made any losses, and so it is still profitable. The major issue, however, with the business is the level of debt. Look at the debt to equity ratio. So the level of debt is very key in this, and this is resulting in 19 million. From our question, this is resulting in a 19 million annual repayment and 9 million annual interest. Let's come to the question and see what you are talking about. So 19 million annual interest. Okay, so this is our interest, which is 19 million here. That is what we have under the current assets, current liabilities, 19 million. And then also a 9 million finance costs here. So that is an issue that the company should be very concerned about. Now, any new investor who was able to reduce this amount as part of any future purchase would put the business in a much stronger cash position. So if a new investor is able to reduce these, then the company will be able to be in a very strong position. Why? Because the amount we are going to use, our cash equivalent, which we are going to use to repay these debts, will no longer hold. So the company is generating, a sizable amount of cash, but because of the large interest payments on our large debts, this is draining our cash position. So if an investor comes in which reduces the equity, the debt position of the business, then we are much likely to have enough money to pay our investors, right? All right. So this is how we analyze our financial statements. So thank you so much for your time. We have covered so much in this question. The question is a standard question. ACCA is it came in 2017. So kindly watch this video again. You can download it and watch again to understand whatever I said in this. In our next video, we are going to look at how to analyze the consolidated financial statements. So be on the lookout for my new videos, and also subscribe to the channel because I will be making videos on financial modeling, financial analysis, accounting, financial reporting and analysis, and also advanced accounting and other accounting and finance concepts. So be sure to subscribe to the channel, and then I'll see you again in my next video.